Folks, earnings are here, and this week I want to talk about earnings numbers. I want to show you what to expect, and I want to talk about the stocks that are reporting this week. A lot of information. You may want to get a pen and a piece of paper, write some of this stuff down, because again, a lot of this is numbers. So earnings estimates fell sharply in the immediate aftermath of the COVID-19 pandemic, with full year 2020 estimates now almost a quarter below the year earlier level, and even 2021 estimates now modestly below the 2019 levels. Ouch. The massive negative revisions trend of the last 3 months appears to have eased in recent days, but that could change as companies start reporting June quarter results next month and provide guidance. Total S&P 500 earnings are expected to decline 43.7% in the second quarter on 11% lower revenue, with the utility sector as the only one expected to have modestly higher earnings relative to the year earlier period. So keep your eye on the utility sector. It may see some upside as a result of that. The brunt of the COVID-19 earnings hit is expected to be in the second quarter of 2020, but declines are expected to continue in the second half of the year as well, though the pace of decline decelerates significantly from the Q2 levels, which means this is the worst time right now, this quarter. If we can get past this quarter, things should look much better looking ahead. For full 2020, total earnings for the S&P 500 index are currently expected to be down 24.1% on 5.7% lower revenue. This is down from close to 8% growth expected at the start of the year. For reference, the S&P 500 declined 19% in 2008 and 3.4% in 2009, though that was admittedly a totally different type of downturn. Please note that while full year 2021 earnings for the S&P 500 index are currently expected to be up 26.8% from the steadily lowered 2020 level, the absolute dollar amount of 2021 earnings estimates remain below the 2019 level. Also note that the finance and the technology sector, the two biggest earning contributors to the S&P 500, are expected to show a second quarter decline of 38.8% for finance. That's huge. And 13.5% for the tech. That is not so bad. Now, that's the smallest earnings decline of the 10 major sectors that will experience a decline in the second quarter. And remember, utilities is the only sector that's expected to show a modest growth. And here's a list of stocks that's going to report this week. I recommend you watch these names because they'll shape the market for the next few weeks, that and the GDP, if not longer. JCPenney reports Tuesday. KB Homes reports Wednesday. Nike and Rite Aid report on Thursday, and Darden Restaurant does too. Nikola, the car manufacturer, reports on Friday. Now, before the end of the week, we'll have some idea of what the second quarter is going to bring our way. And next week, we've got some big tech stocks like Micron reporting. And most importantly, don't forget, we've got GDP this Thursday, and the expectations are negative 5%. If the number is better than that, or above that number, negative 4%, negative 3%, there's a good chance we'll see positive reaction from the stock market. If the number's below 5%, it's not going to be pretty. I hope that helps. Folks, before I set you loose, I need to tell you something important. Legendary trader and fund manager Tom Busby just sent me something in the mail, this tiny black device. Now, what's on this USB drive could be the most pivotal discovery in trading history and lead the average investor to repeating gains as high as 357.53%. Can you imagine making 357+%? That's crazy. Trust me. This is one code that you'll want to crack. So click the link below to get started now. Don't miss out.